Hi everyone, welcome back to Corporate Decoder, the place where we dissect corporate filings so you don't have to. Today we're diving into an 8K filing from TLGY Acquisition Corporation. It's a bit like finding out your blind date is also seeing other people. Things are about to get interesting. Amdal, this report reveals a potential partnership that's as ambitious as it is uncertain, involving crypto, tokens, and a whole lot of negotiation. Buckle up because we're about to decode this corporate puzzle. Let's start with what this filing is. An 8K is like a corporate breaking news report. Companies use it to quickly inform investors about significant events. In this case, it's all about a possible new direction for TLGY. The core of this 8K is a non-binding letter of intent, or LI, with the Athena Foundation. Think of an LOI as a let's see where this goes agreement. It's not a done deal, but it signals serious interest. TLGY and Athena are exploring a corporate partnership. The plan involves TL acquiring a validator business, a service that helps secure the Athena crypto ecosystem. The idea is for TLGY to provide proof-of-stake services, basically verifying transactions on the Athena network. This is particularly important for Athena's upcoming Converge network. Here's where it gets interesting. TLGY wants the option to buy up to $100 million worth of Athena's ENA tokens. These are digital tokens, like crypto coins. The purchase would be at a discount, meaning TLGY would get them for less than the market price. This discount would be agreed upon later. How would TLGY pay for these tokens? The plan is to use a mix of cash from TLGY's trust account and something called PIE's equity from Athena. PIPE stands for Private Investment in Public Equity, meaning Athena would invest directly in TLGY. The exact proportions of cash and equity are yet to be decided and will be at Athena's discretion. The lie also discusses giving TLGY a chance to participate in future discounted token sales. It means TLGY could get more opportunities to buy tokens at a lower price, but again, the details need to be worked out. If the partnership goes through, it's expected to last for 5 years, starting from when a final partnership agreement is signed. In a move to make the deal more appealing to regular shareholders, TLGY sponsors, the people who initially set up the company, are willing to give up a large chunk of their founder shares. In exchange, they'd get earnout shares, meaning they only get the shares if TLGY performs well over time. The exact amount of shares they forfeit will be determined when the final agreement is made. It's important to remember that this is all preliminary. A binding commitment will only happen if a final agreement is signed, and even then it depends on the terms and conditions in that agreement. There's no guarantee TLGY and Athena will actually reach a deal. Before this potential partnership, TLGY has been seeking an extension to complete an initial business deal. TLGY wants more time to find a company to merge with. Shareholders need to approve this extension. TLGY urges its investors and shareholders to read all the documents related to the extension because they contain important information about what it means for TLGY. This 8K itself is about the non-binding LOI, so it's crucial to understand the limitations because there is no guarantee that the parties will reach a final agreement. The terms and conditions of any agreement are up in the air and there is no guarantee it will be completed. A lot needs to happen before any deal is done. Both TLGY and Athena need to thoroughly investigate each other. Their boards need to approve. TLGY needs to follow through with the proposed business combination, and they need to get the necessary regulatory approvals. The report also reminds investors that there are general risks and uncertainties that could cause actual results to be very different from what's currently expected. Investors should not rely too heavily on the forward-looking statements. TLGY and its directors and executive officers may be considered participants in the solicitation of proxies, meaning they may be involved in getting shareholders to vote on the extension. So this disclosure is not a proxy statement or a solicitation. In simple terms, it's not an attempt to get shareholders to vote. It's also not an offer to sell or buy securities after SEFTA. Now, let's step back and look at the big picture. UpBuy seems to be taking a bold step into the biggest risk here is a TL deal, but it's also a sign that they recognize the challenges ahead. Giving up shares in exchange for earnout potential aligns their interests with the long-term success of the company, which is good for shareholders. But the biggest risk here is uncertainty. Non-binding LOI is just a starting point, but there is a lot for uncertainty. Investors should be cautious and not get caught up in the hypes, the challenges ahead. Giving up shares in exchange for Overy seems to be taking a bold step into the world of crypto. Partnering with Athena could be a game changer ahead. Giving up shares in exchange for earned, as a lot of uncertainty I find seems to be taking a bold step into the world of crypto. Partner world is unstable and there's a lot of uncertainty. Depth is a willing, it's high risk, high reward. It's a gamble that could pay off big, but it could also lead to losses. Investors need to weigh the potential benefits